Well, I think investors are focused on two things. One, the Federal Reserve. You mentioned Jim Cramer and his comments about the Federal Reserve tightening too quickly. And two, the tariffs, which are a back and forth negotiation that seems to happen and evolve on a daily basis. I think anyone's outlook about the market over the next few months is dependent upon their belief about what those two things will happen in the future. I believe both of them will be downplayed somewhat in the coming months, and therefore I believe the markets will be higher over the next few months.
Tom, in weeks where we're seeing both Facebook and Apple struggle for momentum, or frankly, having momentum to the downside, is it hard to see the broader market rally again?
Well, there's been a lot of pain, Will, and the idea about trends are surely in place. The S&P 500 breaking below its 200-day average is critical, but if you look at ETF flows, we've seen a huge shift from growth stocks to quality stocks, and that hasn't been in place for about 3 or 4 years. The thing that's most surprising regarding flows is money still coming into emerging market ETFs. The PE on average is around 10, and growth, even though emerging market stocks are down 30% so far this year, tend to be up 20 to 30%. So smart money is betting that China trade deal is going to get fixed, and these folks are jumping on the value bandwagon there because these stock prices are pretty cheap.
Rick, it's been another busy week in terms of Fed speak, including Steve Leisman's interview this morning with the vice chairman of the Fed. How's it been playing out in the bond market?
You know, it's been a very wild week in the bond market for a number of reasons, but I'll give you the easy reason. Right now, we are at 2-month lows should 5-year notes close right around where they're trading now at 289. And it's happened quickly. Just 6 or 7 basis points made a huge difference. We can be looking at the chart as I'm speaking. So, you know, you're down 15 basis points in a 5-year on the week. You're only down, what, about 5 basis points on the week on a 30-year bond. But even the 30-year bond at these levels, should it close here, could be the lowest close since about the 11th of October. I find that the interest rate complex is telling a story here, and I think the story is twofold. One, I think the volatility in the equity markets has actually pushed buyers into treasuries. But I also think there's another channel that's worth mentioning while everybody, of course, pulls their hair out over what the Fed may do. And that is the divergence and the global slowing is taking a toll on bonds. And that's to be expected. That's the logic of the bond market. And also how little volatility they've had today as they softened, even though the equity markets, of course, were livened up by President Trump's comments regarding China and tariffs. And take it a step farther. If you're watching the dollar index, it's closing down on the week, and it's lost some of its best trade around 97. Why do I mention it? If you're out there thinking that the China scenario with the U.S. over trade gets worked out, and obviously it's not going to happen overnight, but should it get worked out, that will be indeed a bearish factor for the dollar because the weakening of the Chinese currency against the greenback has created a lot of channels of trade that have helped bolster the dollar's value.
Brent, on the topic of interest rates, how much is it affecting equity markets? And is it just a sort of superficial factor that will be shaken off, or is there really a kind of significant liquidity impact that's going to have a lasting impact on where valuations are?
So if you look at most financial condition indices right now, they're not very high. They're still pretty tame and in a nice range. And so we haven't seen a ton of tightening of liquidity. But I do think the fear of the Fed tightening too fast is what's driving markets the most. And I think that fear is stemming from the fact that, you know, rates have moved up by 8 times over the past few years, and people are now afraid that the Fed is going to tighten the economy into a submission. I don't believe that's the case. Real rates are still at 0, and I believe the Federal Reserve, once they get to neutral or somewhere closer to neutral, will pause and stop and see where they're at. I don't believe that inflation is the boogeyman to the Federal Reserve anymore. It was post the 1980s, and the Fed was willing to tighten everywhere and anywhere, even if it meant possibly sacrificing future economic growth and employment growth. I think we've shifted. We've had little economic growth over the past 10 years, and inflation has been relatively contained. And so now I believe the Federal Reserve is willing to risk inflation for more potential employment and economic growth. And I believe that means that they're going to try to extend the cycle as long as they can to bring back that 25 to 54-year-old demographic off the sidelines back into the labor force and make longer-term growth prospects more firm.